Let me start tonight with a statement of the obvious. We, Mission, those of us individually, really don't know with any degree of certainty what the economy or the stock or the bond market is going to look like in a year or 2 years. And certainly neither does Ben Bernanke or Treasury Secretary Tim Geithner or even Wall Street gurus like Warren Buffett or Bill Gross. And I'm not simply referring by saying that to the well understood, nobody really knows the future. I'm really saying that there's an extremely broad spectrum of possible outcomes for the economy and in turn both the stock and the bond markets. And any forecasts that you hear or read or I would make tonight are really based on a great many assumptions, many of which are unknowable and I would suggest unforecastable. For example, in the first pages of your book, we've put something which we've titled Great Unknowns, and we're not going to spend any time on this, but we're just throwing out a number, and you could probably add many more. But will businesses begin to rehire? Will consumers resume spending? Will housing remain in a funk? Will the Fed flood the world with dollars? If they do, which many people expect them to do, will other countries retaliate? Will we experience currency wars? Will the people support or oppose Fed policy? Will emerging market countries be able to keep the world economy humming? Will their success lead to runaway commodity prices? One that I think is particularly important is, will untested economies be able to avoid the banking and currency crises that have historically plagued such emerging countries? Will potential bubbles like Chinese housing be properly managed? Will terrorism be controlled? Will countries, cities, or states default on debts, or will they all somehow either escape or be bailed out? Will we end up with inflation or deflation? We're in a highly complex environment with a great many unpredictable conditions. And I'll try to highlight some of what I consider to be the most important of those. And we're going to cover a lot of data tonight. But let's start with the first graph that I have on page 4, which deals with the economy. And this is a graph which I regularly have used for the better part of the last decade. It's extremely important in understanding the current economic situation. And in fact, I have put it first because I think it's probably the most important economic graph. And what we're looking at here is the total credit market debt level, debt load, as a percentage of the gross domestic product, GDP. That's a ratio. As I've explained before, if the level of debt grows commensurately with the growth of the economy, you would expect that this would be a horizontal line going straight across the graph. Now, obviously it's not, which means that debt relative to the size of the economy has vacillated up and down. And you can see, and maybe it's not immediately obvious because you really tend to pay attention to the peaks, but if you look at this period from the 1920s all the way here to 1980, you could put bands above and below that for a period of about 6 decades, with that one exception. And you'll see that that is a general range in which debt has moved. Now, that exception was because of the Depression, and it wasn't because debt went up, it was because the GDP declined. It went down dramatically. So in a mathematical relationship, reduce the denominator, and you get the answer goes, or the index goes higher. And so that's what we had. And the biggest negative we take away from that is that to get back into that normal range, we didn't do it in a favorable way. We did it in many respects because of defaults and foreclosures and debt collapsing. And that's the unfortunate outcome of a situation like a buildup of debt, which relative to the economy we see was here. Now, about the mid to upper or later 1990s, right about in this area, I began to highlight this graph and say that we are now moving into unprecedented territory, ergo, in my view at least, an unprecedented level of danger. We were assuming more debt than we had ever had before relative to the size of the economy. And the danger, of course, is that we have only the one precedent. It may or may not be a forecast of what's to come, but this ended badly, obviously. We've seen the beginning of the turn down here. Most of that has not been because people are actively paying off debt so much as the debt is being extinguished. We've had bankruptcies, we've had foreclosures. And so a lot of that decline has been a kind of forced reduction of debt. And we certainly don't know how this is all going to unfold. We have to hope, certainly, that it is not in any way like the period of the 1930s. Page 5 shows an unfortunate irony, and that is, as the title indicates, as debt rose, GDP growth declined. Now you see on the bottom half of this graph a portion of what we saw on just the prior page. It's the ratio of debt to gross domestic product. What you see at the top is a measure of the productivity, or the production rather, of the economy. So how much, and this is a 10-year rolling number, how much did the economy grow in a 10-year time period? Well, you can see that it was increasing up to about 1980 or thereabouts, which is just about where we started to go exponential in terms of increasing amounts of debt to the size of the economy. And so the ironic thing is, debt is normally a good thing, assuming we're making progress. Debt for a business, if you add leverage and you do well in your business, it multiplies the profit. Well, in this unfortunate instance, as we increase the level of debt to gross domestic product, we saw exactly the wrong outcome. We saw our gross domestic product turning down pretty aggressively, and there does not seem to be any change in that trend. Page 6 shows that the explosion of debt was hardly restricted to the United States. And here we're talking about government debt only relative to the size of the economy, relative to size of the economy as measured by GDP, whereas in the earlier graphs we were looking at total credit market debt. So this is just government debt. And you can see what we've got profiled here. You have Japan, and these three circles represent the levels of debt in 1990, then 2000, and 2010. For Japan, for the United States, and then for the G7, which are the major economic countries of the world. And you can see each has expanded dramatically over that 20-year time period. Japan's obviously is far larger. They have a different dynamic in the economy, and one can say that allows greater debt. But by interesting coincidence, and I have to confess I don't know this person's background, but an analyst named Kyle Bass today was quoted on the financial news channels as saying he expected that Japan's governmental debt would be defaulted on. I don't know what time period, I didn't read anything about it, haven't heard anything specific about it, don't know the time period he's talking about, and so on. It certainly would be a highly unlikely occurrence as long as Japan is able to print its own currency, which of course it can do at this point. The voluminous and very carefully researched work by Carmen Reinhart and Ken Rogoff titled "This Time is Different." I've referenced this at times past, but it's a tremendously scholarly book.